Good morning, everyone. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner. I am joining you all from a beautiful and summery Denver, Colorado today. I am pleased, as always, on a day like today, pleased to be joined by my friend Barb Armstrong in the chat. Of course, it is a solo session, so Barb will be very important to us here in chat, getting to comments and questions that I might be unable to get to during the discussion. Please feel free to post in there for the duration of the show. We'll go about 45 minutes as we usually do, and I'll keep an eye on the chat, of course. Love to hear from y'all as we work through this conversation today. Some good reminders, though. It is a holiday shortened week. The market does close today at 1 p.m. Eastern. That is 11 Mountain for those of you in my time zone. So we do have an abbreviated day. We'll also have an abbreviated day here on the Schwab Network with our updated classes as well. So check the calendar so you know what we're up to here this morning. If you're not already doing so, follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS. We try to post for you there throughout the week, give you some things to be aware of. Barb is fantastic in her posts. If you're looking for some standard motivation on a day-to-day basis, then Barb's timeline is the one you want to follow. If you're looking for some charts, I got a little bit of a problem when it comes to charts. I love posting charts. So if you're following me, you're going to get a lot of charts, everybody. So would love to have your follow there. And of course, if you like today's discussion and topics that we address for you, it'd be helpful to hit that thumbs up button down below for me. And we'll get this out into the archive a little later this morning. That'll help us on a replay basis. With that, let's move into our disclosures, and then we can get into the news of the day. There's plenty to discuss. Please remember that our conversation here is exclusively informational and educational. Remember, we do not make recommendations nor endorsements for a specific approach to trading the market. We will discuss technical analysis, though, in our conversation, and in so doing, we remind you not to make decisions exclusively off what you see in terms of technicals. Ultimately, we think they can be a piece of your overall decision-making puzzle, of course, but we discourage you from just relying on technical analysis to make those decisions. And as usual today, we will work through our agenda through utilizing a top-down methodology. So we're going to start with our broadest of indices. We'll start with the S&P 500, work our way down through the NASDAQ 100, the Russell 2000, looking at the semiconductors as well. I'm going to show you some additional charts of note today, some things that might be helpful, some opportunities to share grid with you all as well. As we kind of look around and evaluate how money's been moving here the last couple of days, notably just the last couple of days, because that's the new quarter moving into the third quarter here this week. So with that, let's take a look at what we got going on this morning. Like I said, there's plenty to talk about. So we have been watching closely the S&P 500, and my goodness, everybody, we got another gap higher today through the blue sky that remains above us, everyone. Why is it blue sky? Well, there is no resistance here on deck. Now, part of the reason that we are witnessing this bit of a gap out of the continuation of the uptrend that we've had was a good jobs report this morning. In fact, the jobs number expectation was better, or the expectation was rather for 110,000 jobs as an increase in the non-farm payrolls, and adjusted upward actually to 147,000 for the month as we came in. So we had more jobs created. We had a lower unemployment rate. Expectation was for the unemployment rate to rise up to 4.3%, and instead it fell to 4.1%. So the market taking today's intraday or initial reaction to jobs as a fantastic development on the health of the overall economy. And so you're seeing a little bit of a rise out of this as a result this morning. Let me take a quick peek at the details I had. And one of the charts that I like to just keep an eye on, everybody, if you'll notice here, I've got the future symbols for the S&P 500 on the left, and the middle is for the NASDAQ 100 and the Russell 2000 on the right. And you can see that the S&P here on the left and the NASDAQ 100 both reacting relatively favorably initially off of that reaction, off that news. Now the Russell breathing a little here. We'll see if this gets legs after a brief respite here off the open. But you can see large cap stocks NASDAQ 100 doing very well on the heels of this announcement, and it looks like we may be able to push the Russell back upward here as well. So we'll keep an eye on that. But from a standpoint of watching the market, this is one of those charts that some traders might lean into because reactionary to news headlines, utilizing the futures in the pre-market can at least give you some indication of narrative and the understanding of how a news bill or how a bit of news might be portrayed in price action. So the S&P continues to rise. We definitely know that the 20-day moving average is climbing further. We're moving through areas of horizontal support. We've talked about 6,055, everybody, but that's 200 points away now all of a sudden for us. Now, the ledge that created the all-time highs is at about 6140 to 6150. So we're still 100 points above that. So how are you traders maybe thinking about managing your individual trades in here? I mean, the 20-day moving average can work, but if you're giving up a couple hundred points to find support, not everybody's going to want to stick with their position that way. Some of you might want a faster, speedier moving average. Maybe a 10-day moving average would be appropriate, but look where the 10 is. It's still about 100 plus away, 115, 120 away. So I bring this up, everybody, because I want you to be thoughtful about how you're going to continue to manage trades in something like the S&P with just continuing to push higher. Part of this job of a trader is to acknowledge that we have this run in place. We're trying to take advantage of said development, of course, but raising stops along the way and working to manage and maintain our profits, and ultimately knowing how is it you as a trader are going to then say, all right, here's where I start to move out of my trade. I'm going to do that based on A, maybe some weakness, or B, forget weakness. I don't like selling on weakness. I like to sell into strength. Which of these scenarios is the one that applies to you as the trader? And remember, while we can always see the market continue the trend that's been working, we don't know how long that's going to go. And so as individuals, having some levels set, knowing where you want to take action becomes very, very important, even as we continue to climb like this. So with this in mind, if we're going to continue to work and push higher, it's fine to stay invested. It's fine to stay fully deployed in your dollars, right, to the market, because of the trend and the move we've had has been so consistent. But you need to always be prepared for when things change, because one thing we know is that the market is not static. It will change, and what's working today will shift and suddenly not work down the road. We just don't know when. And so know the things that are going to help you base your decisions. Is it a 10-day moving average? Maybe it's a very fast 5-day moving average, or even the 20-day because you're more comfortable with the overall trend. Just know how you feel about that and the levels that are going to help you make your decision. So let me go ahead and throw my traditional 20, 50, and 200-day simple moving averages back there. And then I'm going to mention elsewhere, also, everybody, that golden cross. I was looking for some data on the so-called golden cross here in the S&P 500, dating back quite a while. In fact, we can go back 75 years on this data, everybody. And some of the pieces I'm going to share with you here, I think might be a little bit shocking as it relates to the so-called golden cross, with the 50-day moving average crossing the 200-day to the upside. Since 1950, there have been 37 instances of this occurrence. And in those 37 instances, the market has been higher on a 1-month basis, almost 60% of the time, 59.5%. On a 3-month basis following the golden cross, the market, the S&P, up 28 out of 37 times. That's a 75% clip. 6 months after the golden cross, up 30 out of 37 for 81%. And a 1-year basis after the golden cross, also 30 out of 37 for 81%. Now, again, none of these are numbers that are going to be guaranteed in any way. This is how traders consider probabilities, though, right? And when you look at it, you see that on average, The 3-month return comes in around 1.1%, or pardon me, 4.4%, 1.1 on a 1-month basis. And I think what it speaks to when I look at this discrepancy, 22 times out of 37, we are higher 1 month later, but 28 out of 37 times we are higher over 3 months. And I think what it speaks to once more is something we've talked a little bit about here in this class over the last couple of weeks, which is that the initial cross of the 50 through the 200 to the upside doesn't always mean an expedient move to the upside. It often means a period of short-term consolidation, sideways, not necessarily a direct beeline higher. But as you pass the 3-month clip, as you pass the 6-month clip, you notice that those returns tend to increase, and the consistency of achieving those returns tends to increase as well. So this is not to suggest that it's only higher from here. We know better than that. Again, probabilities may lead us that direction. They may give you traders a little bit more comfort in the short term, but nonetheless, our job, manage our trades, raise our stops, utilize our exit strategies consistently, and basically adhere to your game plan, everybody, whatever game plan that might be. For some of you, it's the run and shoot, and for others, it's a methodical ground game where you just look to grind it out over 4 quarters. Whichever one of those is best for you is the one you want to stick with, okay? All right, so there's our S&P gap and go move potentially today. Nice little finish. Remember, with a shortened market holiday, we can absolutely get a little bit more volatility just on lighter volume. Do not expect to see a whole lot of volume in the market on a half day like today. Now, there's the NASDAQ moving higher as well. Let's zoom in on this. We've got bullish behavior in a couple of ways. We have a gap move out of a very quick bull flag to new highs in the NDX. We've got the NDX cresting and moving back up above the 70 line once more, confirmatory in nature. And you've got the bullish cross, 50-day crossing the 200 to the upside at a zone of potential horizontal support. That is moving upward quickly because our price action in the NDX continues to rise quickly as well. So some traders may use that 20-day moving average. We can see the horizontal support. Remember, 22,200 was our all-time high previous. So now that we are through it, some of you might just say, let's make that a green line, Kev. We'll call that horizontal support. And notice that 20-day is catching up there as well, strengthening the likelihood that this is an area of short-run support for some of you out there in your time frame. So I think that's a pretty good review as it relates to the NDX continuation. Today will be day 50 above. I think it's day 50. I'm going to draw that line one more time, everybody. Let me just see here. Day 1 above the 20-day back April 23rd. And with today's action, it will be day 50 consecutively closing above the 20 days. So that'll be 10 full weeks above the 20-day moving average for both the NDX and the SPX, assuming closes above it today. Hey, I see we've got a survey, everybody. Always appreciate hearing from you. If you don't mind, take a moment and just click that link for me. It's going to open in a browser window right next to this one, and then you can get to it post-show. All it is a single score for you, and an opportunity for you to provide comments or ask questions. Either are fine. Look, if you make any comments, all of that stuff comes to me directly. I love reading what you have to say. I try to bring it into our discussions. In fact, one of the things that I have heard from many of you frequent attendees is that you'd like more in the way of individual stocks in terms of review, especially on the Thursday session when I host solo. And of course, being that is the case today, I've got some stocks in the news that we're going to look at. I've also got a position that we put on a couple of weeks ago, and we're going to look at as well, or rather last week, excuse me, and we're going to look at that again and see how that position is working, see what we need to do from an exit strategy standpoint. So we, of course, try to bring in your questions and your commentary as best we can. So it is important. Take just a minute. Let me know what you're thinking here about this segment, this class, and I'd love to hear from you, get your input. Okay, so there's a quick look. We've got the S&P covered. We've got the NASDAQ 100 covered. And now it looks like the Russell 2000s in form of leadership here, everybody. Going to be really hard to call this anything other than bullish, everyone, as we have gotten a 3-day springboard off the 200-day moving average. Check this out, everyone. I mean, what a great maneuver. 3 days in a row, moving off the 200-day. Day 3 of a breakout, day 3 above a 200-day moving average. Many traders are going to look at this as a strong view of the Russell 2000 making new levels, achieving new levels, allowing you traders to raise your exit strategies on Russell 2000 collectively, or maybe even Russell 2000 positions. But I'll tell you, everybody, when you've got groups moving to new highs, RSI into overbought conditions, this is telling us that the market price action is stronger than maybe we have expected. And look, we can deny what is in our face right here. I'm just not sure if denial is the right approach. Going against the grain has proven to be a very difficult thing for many traders. Yeah, you're right, Wiley. Today could be day 3 of that so-called Horner rule, whether it's a 3-day thing or maybe for some of you 2 days. You might be looking at a confirmation breakout day today. What is most enthusiastic, I think, about this is the achievement of the 200-day from a bullish standpoint. But again, the narrative behind it, everybody, we generated more jobs. The unemployment rate fell. Those aren't negatives. Those are positives for the underlying economy. And so, hey, maybe what we're seeing here is more of that positivity than expected. And I think perhaps price action is giving us a little bit more of an indication of that strength and the potential of the overall economic health, going forward. And when I say going forward, remember, it can be hard to balance the current economic detail we have in our day-to-day lives against market price action. But market price action often is 6 to 12 months in advance of what you're dealing with on a day-to-day basis in your own economic viewpoint, right? The market is a discounting method. It's always looking forward, not so much paying attention to what's happening immediately at this moment in time. So the expectation here is, hey, maybe 6 to 9 months down the road, we are expected to see vast improvements in the health of the U.S. economy. That is what maybe some of this price action could be dictating. We'll see if the market, the actual economy plays out in the exact way that the market is forecasting right now. But it'd be really hard to discount what we are seeing from small caps here today. It's a really nice kick to the upside. All right. Let's see. Yeah, a couple of you are pointing out. Kevin, we're going to talk about Datadog here in a little bit, getting added to the S&P 500 as of next week. So we will look at that momentarily. But let's take a look at the semis here and getting some follow through on the semis, everybody. We are at the highest level in this index since all the way back to our gap here from July of last year. So we have got a wonderful developing new uptrend. Again, the 20-day moving average for you short-term bulls can provide you with some areas of support. We are about 300 points above it. So that does matter to some of you, as we just got done talking about with the S&P and the NASDAQ both. If you're going to be a seller on weakness and a true trend break, you might not sell for 300 points to the downside. And again, the important aspect when I give you those details is you got to figure out, what does that mean to your bottom line? Meaning, if I have X dollars devoted to the trade at any given moment in time, and the index was to sell off 300 points, what would that equate to for you in terms of your position? What would that look like? All of that has an impact on your decision making, or at least it should be part of your decision making process, I think. So you can always be cognizant of, this is how much my position would drop if the index were to drop like this, and my position made a commensurate move to the downside. How much of my existing profit would I be giving up if that happened? And then you could say, yeah, I don't think I'd like to give up that amount of profit. And that might lead you to selling a little into strength rather than allowing the pullback to occur. So with this in mind, set those levels, know where it is you would look to make some changes, what price action matters to you in that way. Okay. All right, let's look at one more here, and that's the transports. Now, many of you point out we don't get to the transports too often. You're not wrong by that, by stating that by any means. In fact, the transport index here, you can see, had been on a little bit of a downtrend. If I back this out to make this maybe a multi-year chart, let's make it 3 years. Check this out. We did have an uptrend working until that uptrend went away when we broke down here in March. And what's interesting to me, everybody, we broke down here ahead of the biggest moves in the broad market. Now, remember, one of those technical analysis 101 things, what once provided support, like this trend line, could then provide resistance once broken. So the fact is, we are right back there at that line. Now, some of you, as an example only, if you were a trader that bought into the Dow Jones transports back here off the lows, or maybe back here in late April when we recaptured the 20-day, this might be a spot where some traders would take a little bit off, okay? Just based on that, having run into what was the former uptrend line, it could be resistance. Doesn't mean we have to be sellers or anything like that, but it does give you an idea as to how some traders might take it. Today being day 3 above the 200-day moving average, you may start to expect a little consolidation, a little sideways. We don't know, but you know, we can see that the 20-day here has been a little bit consistent as well. Maybe not as consistent as we've seen it with the S&P 500 and the NASDAQ 100, but this has been a positive move in the transports, but not as positive as we would like just yet. We would really ideally like to see some continuation and get back up above that former uptrend line so we can use it back again as support instead of resistance. So we'll see if that plays, but that's going to remain, needs a little bit more time, remains to be seen, I might suggest. So, all right, so there's your transports. Now, and looking around today, one of the other charts that I wanted to share with you, you all know that I like this one that Rachel brought in, and Brett and I spoke about this one yesterday. Rachel's been such a big help in giving us some of these broad market looks and at the market. But one she also shared that I'm going to bring up here is the performance and the sector rotation, but performance of these individual sectors versus the S&P 500. And so these green lines, these are not true price chart lines, but rather the returns relative to the S&P 500. So in the lower right, you'll see this is the S&P. That's why it's a flat line, right? Because we're comparing the S&P to the S&P. That's going to be flat. But if you looked at all of these, which of these are providing leadership? Well, it's not energy. Energy is clearly lagging the SPX. Same with materials. But industrials has been out there kind of giving us some leadership until the recent period here where we've kind of pulled back a bit. But this is a really instructive look at things, everybody, because what it's telling us is that while we have bullish stuff, bullish charts in a number of these key sectors, they're not all outperforming the S&P 500. And that's a pretty good takeaway, right? I mean, many would suggest, oh, I should be long consumer tech, consumer discretionary, but it's been lagging the SPX. Only tech and industrials have really been outperforming. Communications doing really well too, I should point out. But look at all of the other ones. Your utilities obviously lagging, real estate obviously lagging, healthcare, same thing. And you know what? We've got financials at new highs collectively, and yet lagging the SPX as a whole. So I thought this was a really instructive look at things. I'm happy to share this one with you. I'm going to throw this into the chat for you all, because again, we have to evaluate the market on a multitude of levels, everybody, and taking a look at this is pretty intriguing to me. So these grids, as a reminder, these are not a guarantee for timing. They are not a guarantee for accuracy. They are not a recommendation for use, but I am happy to share that with you all there in the chat. Remember, don't click the link here, everybody. Don't click the grid symbols or the actual link provided, but copy it and go ahead and place it up here via setup, open shared item, paste it, preview it, and then import it. All right. I know a lot of you, every time I share a grid like this, you all are very excited. You want to get a piece of it, and I don't blame you. So happy to share that with you all there. And for those of you catching this in the archive, I'll make sure that that is also in the notes down below. So all you need to do is open up the show notes and you can find that once more, and we can go forward from there. And yeah, great call out, Bill. All sectors in the green. Clearly the overall job report very well received here, and perhaps a little bit of lack of volume in today's open could be, more or less just pushing the market higher for simple reasons, right? Could be as simple as lack of volume, but direction very well clearly stated, not a negative, right? We're going to go with what we have at our fingertips today. So quick hit here. There's your industrials making highs. Wow, what a fantastic development. That's great. I mean, 20-day moving average is getting caught up here to our former resistance. Boy, just a 2-week explosion here since June 23rd. That looks pretty darn strong. So industrials moving to the upside, and then our discretionary trying to break out of this rangy situation, everybody, and it has moved to new highs. Now, there's a bit of resistance here. Perhaps, this was a bit of a gap level and the low that we had achieved here back at the beginning of January. So maybe we need to pop through this ledge here on discretionary for some validation. But nonetheless, getting outside of this period of sideways action is probably the most important thing for this particular sector. So the fact is, you're outside of that. A lot of traders will tell you that that's going to be well received, especially if we can pop through 1785 here in discretionary. So all in all, a pretty strong sector day at this moment. Now it's early. We know we have a shortened day, but a little early, but we'll take what we can get off the open here, everybody. What do you say? Let's get into some of these stocks in the news and the position we put on recently. I'm going to go to my monitor page and let's take a look. We added for a trade, we put on a trade in RTX. Now, take a look at our original entrance was just a 626. So yeah, just a week ago. Now, when we bought RTX, we had been looking at defense and aerospace essentially, and the group had been doing well, and RTX itself had been holding its 20-day moving average. And so if we go back to the 26th here, you'll see we were sitting on it, but we had, at the moment we talked here, we were trading above the high of the low day. This was our low day in the pullback and gave us the low price. And then the following day, the 26th, in this class, we were seeing us trading above this level. Thought process could be, hey, let's go ahead and look to take an opportunity here. We had been above the 20-day dating back really to around here, April 29 or so. And we had been supportive with that along the way. And so you've had a few tests there. You've had one right here. And then, of course, you've had this whole smattering of tests along the way. Notice, of course, though, each one of these is a higher low every step, right, everyone? The 20-day moving average rising in concert with everything else. So this has given us an opportunity to look at RTX in a bullish fashion. Now, we do not have an exit plan on this position. The reason being, I wanted us to be able to talk about this one today by maintaining it. I didn't want to get stopped out. I didn't want to have any risk of being stopped out. I wanted to make sure that we had a discussion topic. So the fact now that we have put on the position, stock has continued to move higher. We only have a small position, 25 shares. I want to make two suggestions as examples of ways traders might look at this. Being that we're watching the 20-day and have been above it since the 29th, 30th of April, some of you as short-term traders would just say, as long as we close above the 20-day, we have every reason to stick with the trade. And many traders would agree with that thought process. Now, the other way we can look at this, two things. One, we can consider adding to this position on a close at new short-term highs. Okay, so trade on a closing basis through 149 could be a trader taking or adding to this trade. So we're in 25 shares. If that was 25% of our ideal position, the trader on a breakout might choose to buy another 25 shares. Okay, or maybe they say, you know what, on a breakout, a close through 150, I'll buy the remaining 75. I want to be in a full position as it moves to new highs. That's up to the trader, of course, but have that plan in place. Now, the alternative to not just adding to the trade is we need to make an exit plan if this isn't going to work in our favor. And so when I'm looking at this, some traders would say, let's take the low that we've made, which actually goes back 2 days. July 1's low was 142.66, and they might want to put a stop order under 142.66. And you can do this any way that you, the trader, would like. Some traders will stick very close to 142.66, believing that it shouldn't get below it even on an intraday basis. And they might just pick out a figure, maybe 142.5, maybe 142 even. But you can alternatively go with something like the average true range, which it looks like I didn't. There it is. It is added there. ATR down below is $2.81 at this moment in time. So maybe what we do is we just take the 20-day moving average. Let me find my calculator. The 20-day today at 143.53 there. Okay. And then let's just reduce it by the amount of our ATR, $2.81. And that gives us 140.72. And that could be a stop exit strategy. And you know what? When I put a level there, boy, that doesn't look terrible, does it? Because it would violate this ledge here, right? And so if we chose 140.72, we would basically be testing these lows, and that would be pretty big move beneath the 20-day moving average. So, not terrible, but that's just one other way that some of you traders might make that calculation. By the way, 2.81 from our 20-day moving average at 143.53, that would be a near 2% fall through the 20-day. So one final note here, everybody. I'm seeing some of you. Thank you, Paul. I appreciate your comment here, because you're explaining that you have a plan. You have a process that equates to the average true range. The mechanism of average true range is part of your decision-making process. Excellent. So I wanted to talk about that as an example. One ATR below your 20-day moving average can work for a lot of traders. An alternative method can be that if you fall through support, what you deem to be support, by 1% intraday, that could be a number 2. Other traders might say 2% intraday. Okay, but build a number out, give yourself something to refer to and a decision that you can make. That's a great process, right? I can't give you the specific that's going to work for you, but the plan should be there, and you want to adhere to your specifics for your tolerance, your comfort, and so on. At least that's the way that I think a lot of traders are going to try to manage a trade like this one. So let's go in. We're going to go with my 140.72 exit on a stop. It would leave us, because we entered here at 142.53. We're going to lose on that trade if we do get stopped out there, but most likely that is. But I'm more concerned about capital preservation than I am anything else. So let's just apply that order, everybody. The easiest thing to do might be in the chart to right click and sell. But I think a lot of you traders would probably prefer to do it right from the monitor page, in which case when I click on it here and create closing order, my default is to selling the entirety of my position. So I'm going to say with stop, and here it's going to load. Stop. I got to make that good till canceled. And again, 140.72 is my number on the math that I've done. And then my reminder to all of you, of course, is that while we have this as a trigger, this is by no means going to guarantee our price. because once triggered, we get a market order to sell. And that means that we have gap risk. So if we were above my stop on a close of business today and open below it on Monday, for example, at 135, our exit's going to be pretty close to 135. It's not likely to be close to 140.72. So we do assume that gap risk, everybody. All right, so I'm going to confirm and send that. Now we've got our protective order in there on RTX. Let me put that back in there just to make sure. Yep, there we are at 140.72. And of course, if it does in fact make new highs, closes over that 149.26, then we could consider raising the stop once more. Hopefully that's what we get to discuss now in a couple of weeks, because next week I will be in Santa Clara for those of you attending the event out there, or our next workshop, technical analysis and options. So hopefully I get to shake some hands, see some of you there, but I will have a guest host for this show next Thursday. All right, let's talk about some stocks that are in the news this morning for a multitude of reasons. I'm going to reset my moving averages and details. We talked a little bit about Datadog. As I mentioned, that they have been added to the S&P or will be added to the SPX here next week on the 9th. As you can see, the stock is getting a nice little lift today. We're up about 11%. We have moved through some significant zones. A lot of traders were working at resistance here. I mean, we had just climbed right to it. And here you go, everybody, popped right through. And now you've got a new layer of potential support. We could make that green right there at around 137. That's one area. And then, of course, anytime you gap, everybody, a lot of traders are just going to say, well, let's just use the low of the gap. And then we can work with it as a potential for exits. And that's around 147. Okay, so some excellent movement here. So some incredible move here. We'll see if that rolls, that continues. At this point, because of the moving averages going so, because the price action has exploded to the upside, our moving averages might not be fast enough to catch up and give you a reason for selling on weakness. So you might want to keep an eye on some of these horizontal levels. Again, let me pop those in here for you, everybody. Right here is about, we're going to call that 147. And then we'll duplicate it. And then this one comes in right around 137 or so. Whoops. There we go. And I'm a little particular, so I always like to not just update the text, but I like to update the value. That way it's at the value I'm telling you it's at there. So 137, one ledge, 147 more immediate. You know, trades under 147. I could see some traders, you know, patting themselves on the back for a portion of it and taking a little bit of profit. Nothing wrong with that, though. So that's a positive. Obviously, Datadog getting added. It's going to replace Juniper Networks in the S&P as of next Wednesday, the 9th. And just for good measure, because we're talking that, look at Juniper real quick, having a little bit of, a little bit of a quiet morning on, is that legit? Oh, here we are. Here. Placing Juniper. Okay, so let me check on that. I think that looks like. All right, I'm going to have to, because I missed the news on this one, everybody. Oh, yeah, there it is. HPE closing the acquisition. Okay, there we are. So HPE acquires Juniper. That's why we're getting rid of Juniper and Juniper being replaced by Datadog. Okay, that's why the price action, you're not getting any change because it's no longer there. It's applied now all to HPE. So there you go. You can watch HP if you want to see any otherwise relationship there. Okay, other stocks in the news for you all this morning. Had a couple other upgrades, so we'll hit up those. Let's look at Meta real briefly here. So Meta was upgraded we're up 1%, not a huge move, but Needham upgrading Meta to hold from outperformed. They did not offer a price target, so heads up to that extent. The analysts remain essentially with a hold because the firm believes that Meta's strategy diffusion wastes capital and adds risk, and the company's margins and free cash flow are under structural downward pressure. So that's a little bit of a heads up, I suppose. But upgrading to hold from underperform, that's going to be a step in the right direction. It's certainly not a buy rec, but an upgrade nonetheless. So it's a little muted in terms of the price action here today on Meta. But ultimately, what are we going to say about a stock in an uptrend at highs? What we have is a retreat to support. A lot of traders, you're going to call this out as well. I imagine many of you saying, hey, Kevin, that looks like a bit of a bull flag to me. And you would that would be, how a lot of traders would digest that, would be a bull flag as well. The reminder being, if you're trading it for the bull flag, right, we don't necessarily trade it when it's in the cloth portion of the flag. We wait for the break to know how to trade it, whether that's maybe the pullback to an offer of support. Maybe you can be a buyer at 707 with really tight downside risk, right? An exit below the 20-day on a close would be one way to look at it. Alternatively, many bulls would say you buy it when you break the downtrend line to the upside, and that's when your trade becomes opportunistic. And of course, on the weekly, you'll see that there is no nothing but blue sky up above. So, again, no resistance. It can be difficult to set your targets, but that doesn't mean that there's not more upside. So keep that in mind. Does look a little cup and handle-ish here with this action, and then this most recent move would validate that as we've moved through and made new highs. But as always, know the trend that you're stepping into here, everybody. That 20-day moving average, again, has been working since April 25th. Here, it does have a successful retest just a couple of days later. So the 20-day appears to be pretty stout as well for short-term bulls from a risk management standpoint. That looks pretty notable too. Another upgrade this morning was on Huntington Bank, HBAN. We talked a little earlier about how financials have been rolling. We've seen a bit of a breakout here. The most recent 2 weeks have been fantastic. But once it's got going in earnest when we cleared this mid-level here, notice the 20-day moving average. I bring the 20-day up here because you can see it's been not as consistent, right? Sometimes we find the consistency and sometimes we're not shown it at all. Here, the 20-day has not been very helpful. We were below it for a multitude of days in here. The 50-day appears to be more consistent now. And so that tells you your longer range trend might be a little more appropriate. But this has also been on a developing, improving chart for a while since we broke the downtrend line. And a couple of key reminders. You broke the downtrend line and then you got thrown back to the downtrend line. Now, why do I keep bringing this stuff up? So that you can continue to see the instances in which this occurs. Break out of the downtrend line, throw back to the downtrend line for a test. That test, once held, is validation of that new level. New traders can step in with a little more confidence. These are the steps I want to give you and I want to remind you of. As we know, these processes won't work every time, but they work more frequently with a broken down trend line and a retest. Now you've got confirmation. And again, it's just reiterating these concepts that many of us have read about, learned about in books, and it can be difficult when you're learning this stuff to take theoretical information and apply it to real world with only theoretical backing. Meaning you've seen it in a book, you saw it on a chart from 12 years ago, but you hadn't seen it develop in real time. But that development in real time can solidify the learning. And that's why I continually bring these things to you when it happens, because seeing it develop live and in the moment can do a wonderful job for us all. You can really reiterate that learning process. So Huntington Bank, getting an upgrade at Wolf Research today. They have been upgraded to outperform. Previous had been at peer perform. Target here is at $21. That is still about a 20% lift from where we are right now. Now, again, I got to point out, as you all know, that is not a guaranteed price to be achieved. $21 in no way. It would be a new high on the weekly chart, even if we got to 21, of course. But it's not a guarantee to be achieved, whether that's the analyst at Wolf giving you that, whether that's a measured move target. If I was to give you a measured move target, it might just be this range here, right? We've had the upper range was around 16 and a quarter, and then the lower range around 15 and a quarter. So from 16 and a quarter up to 1750, many traders would say we've already made the short-term measured move, and you wouldn't be wrong, honestly. I mean, that mathematically that looks valid. And now we are at the highest we have seen Huntington since back in December of last year. So again, set your risk accordingly. Know how you as the trader are going to manage it. But up there at 1845, having been there before, that might be a spot where some traders would look to grab a few dollars in profits. But that might be different for you. So know your plan, stick to your plan. Speaking of the plan, we got that survey request in there, everybody. Take a minute and fill that out for me again. Score is just fine, but if you want to just provide some ideas and commentary, I'd love to hear from you. Take a moment to do just that. So glad you all joined me today. Brief discussion, but lots covered here on Trader Talk. I'd love to hear from you outside of the session. Follow me on X, Kevin Horner CS. Follow Barb there as well, Barb Armstrong CS. And make sure you hit that thumbs up button down below if you like today's topics and discussion. I appreciate you all joining us. So remember, abbreviated day, market will close at 1 p.m. Eastern today, closed all day tomorrow. That means I will be back with you all Monday morning for Trader Talk. I hope you all have a fantastic holiday weekend. I look forward to seeing you all again real soon.